With massive layoffs in nearly every sector, weakness in manufacturing, car sales and housing, and the biggest one-month decline in the trade deficit since the financial crisis, the economic picture is not looking good, which might explain why so many billionaires are loading up on gold, including hedge fund manager John Paulson and real estate mogul Sam Zell. Bottom line, now is the time to own gold, which is why the experts at Stansberry Research just stepped forward with a major gold prediction, arguing gold could soar as high as $3,000 by the end of the year, possibly even higher. You can find out why and get instant access to their #1 gold investment today. It's not bullion, an ETF, or a mining stock, but in the past, this gold strategy could have made you nearly 50x your money. Considering how quickly the price of gold has been moving in recent weeks, you don't want to waste any time missing out on the gains these experts believe are in store for this gold stock. To get a copy of his new free report with all the details, simply go to goldmaniareport.com. Again, that's goldmaniareport.com for a free copy of his new report. Hi, this is Daniela Cambone, and welcome back to the Daniela Cambone Show. And my guest today says it's looking more and more likely that a no landing scenario is in the cards from the Fed and for the economy. So please welcome to the show, for the first time ever, Jim Bianco, founder and president over at Bianco Research. Jim, nice to finally meet you. Happy to have you on.
Yeah, thanks. I'm glad to be here.
Yeah, well, want to talk a lot of various topics with you today, but let's start with the Fed. I mean, we see how volatile the market gets after, Fed Chairman Powell's remarks. I mean, market reactions, as you know, included a yield spike at the front end of the bond market, with the 2-year breaking 5% for the first time since '07, and across the board sell-off in stocks, with the S&P dropping 1.5%. and the 2- and 10-year yield curve spread breaching minus 100 basis points. I guess my question to you is, does it need to be this way? Because the more the volatility, the greater the risk of economic accidents here, Jim.
Yeah, unfortunately, I do think it needs to be this way. Wall Street's been operating under an assumption for the last several months. The Fed is, assuming that we get a 25 or 50 basis point hike, on March 22nd, we're going to get one or the other. The Fed will have raised rates 5% or 500 basis points in a year. No more analysis needs to be done. That's too much, and that's going to break the economy. And that's why you've got everybody calling for a recession or a hard landing or a soft landing, because that's a gigantic rise in interest rates. Like I said, no more analysis needs to be done. And then we run out stuff about what's happening in the housing market, and because that's the most interest sensitive part of the economy, that's hurting because of higher rates. So my point is, right, we are all expecting a giant downturn. And it was no more epitomated, or the epitome of that was Senator Liz Warren's questions to Jay Powell yesterday. What are you going to tell those 2 million people that lose their jobs because you've raised rates? And Jay Powell was like, well, no one's lost their job. Well, they're going to lose their jobs because you're raising rates. And what are you going to tell those people? And then Jay said, well, you want me to stop doing my job and let inflation go to 5 or 6%. So this is the assumption that we've got in the market. So therefore, what you've seen, which is driving the volatility, is everybody's been afraid because of reputational risk to say, look, I think the Fed's going to go to 6 or 7 or 8% or some gigantic number. So we would perpetually, we're okay with being wrong 14 times by being too light on our interest rate calls. So this is why we have this volatility. We have this inability to understand what the Fed is trying to do. I actually have been one that's been kind of on the Fed's side here, which is unusual for me. I think inflation is a problem. I think inflation is persistent. I think gone is the word deflation. We don't need to talk about that word anymore. I think that we are now in a permanently higher inflation world, and interest rates are going to stay up, maybe go higher, and not come down that much when the economy slows. That is something that a lot of people have a hard time getting their head around. So this is why we have this volatility. We haven't been able to accurately understand what's been going on with the Fed And we've been chronically talking about pause and pivot and step down, and they're going to stop, and we're going to have a recession, and it's a terrible mistake. And all the data is saying that the problem with the economy to date is that there is no problem with the economy. There is no evidence of a hard landing. I don't even think there's evidence of a soft landing. I think there's evidence of what is referred to as no landing. And that means that there's nothing wrong with the economy. It just continues. Yes, housing has a problem. Real estate has a problem because it's highly leveraged interest rates. That's their problem. That's what Jay Powell said. That's your problem. It's not the economy's problem. So that's why I think we see all this volatility. Now, whether it leads to a mistake, yeah. Historically, the Fed raises rates too much until something breaks.
Right.
But is that 5.25 or is that 8? We're not sure yet what that level is going to be.
I would have to say I agree with you on most of those points, Jim.
It's a difficult thing for people to get their head around, is that this idea that the Fed's raised rates 500 basis points and maybe we're just at neutral, or maybe we're not even at neutral just yet. What do you mean? Of course, it's got to be too much. Of course, look at what's happened to housing. Right. That's what I hear all the time.
Right.
Because it's the most interest-sensitive part of the economy, it's always going to wobble when rates go up. But that doesn't mean the whole economy does.
And this all makes sense. But this will all unfold now before an upcoming, we're still months away, but it's going to be here quicker than we think, a presidential election. And we know the Fed operates independently. But do you think the election factor can change any of this narrative? Because no one will win an election under a recession.
No, I don't think it will. Because if you look at the Fed's recent history, they did their most extreme actions in the history of the Federal Reserve literally days before the 2008 election. They raised rates before 2012. They raised rates. They began the rate hiking campaign in late 2015, early 2016. And then, of course, we had the wild Fed movements in 2020 because of the pandemic. Actually, if you look at the last 4 Fed cycles, usually what the Fed does is they wait till right before a presidential election, then they pull out the extreme moves. That's what's basically happened in the last 4 cycles. So, no, I think the Fed has shown for the last 4 cycles again that November 2024 is not going to change anything for them. Whatever they think is the appropriate policy will be what they do. If that means aggressively raising rates, or if that means cutting rates because we're in a recession, or whatever that means, they're not going to stop because there's an election coming up.
And let me ask you this, Jim, because I'm on the road a lot for obviously my work, and when I speak to the folks, all of this is just so overwhelming. You talk recession. Are we in a recession? When will the recession hit? How will we know? And I had one expert on that said, trust me, if you're in a recession, you will know. Like maybe you're feeling it now, maybe you're not. I mean, what's your take on navigating through all these, the divergent data we get, like, and how to make sense of it? What do we do with it? How do we navigate it?
Right. A recession is when your neighbor loses your job, and a depression is when you lose your job. I mean, that's the old line about that as well. As far as navigating it goes, you're right. You hear people talk about unprecedented, difficult. These are the words that we try to use to understand what's going on with the economy. I would suggest the following. It's a post-pandemic economy. Now, that's a fancy word. What does that mean? What that means is we did something truly extraordinary in 2020 that is, in my mind, one of the most extraordinary economic events of our lifetime. We shut down the global economy and then we restarted it. And we underestimate the power that has on the rest of the economy. It changed a lot of things. The biggest, most outward change that we are aware of because of that is now work from home. Prior to and this comes from Nick Bloom at Stanford University, prior to the shutdown of the economy in 2020, something like 4 or 5% of the workforce was remote work. Yeah. Now it's about a quarter to a third. It's probably going to continue to move higher on remote work, not lower. That has permanently altered the commercial real estate market, Now it will have to remake itself into something different, whether we make these buildings condominiums or tear them down or whatever. We're going to have to reinvent cities along the way. This is epic stuff. So the reason that people are struggling with this economy is because, as I like to say, they're waiting for 2019, the pre-pandemic world to arrive. The Fed does this. We're talking about data dependency. What that means is, here's the way the world worked in 2019, pre-pandemic. And we're waiting for those rules to start working again. They're not. There's a new set of rules now that we have. And I don't pretend to know what those rules are, but I can tell you they're not 2019. This is a very different economy. Yep. Different does not mean dystopian. It does not mean it's worse. It's a banana. It's not an orange. A banana is no worse than an orange. And so we need to understand what we're dealing with. This is the way people have to start thinking about the economy. The biggest problem that I'll hear people say it, I don't understand it, and then they'll basically explain to me the way the world worked before the pandemic. And then they'll say, when is that going to return? When 94% of all of the offices in Midtown Manhattan are full again. And they're not. They're just not going to be full again with workers to that level again. That was 2019. They're probably about 50 or 60% full. And I think, like I said, they're probably going to go lower in the terms over the next couple of years and not higher. That's just one example. The other example is the reopening in China. Everybody's saying, well, now that they've ended zero COVID and now that the latest COVID wave is over, remember what China looked like in 2019. They're going to go right back to that. And it's very apparent to me, at least, they're not. Yes, they're reopening. Yes, their economy will uptick, but it's not going to be a return to 2019. It's not going to be everybody back to the factory in China, make a bunch of stuff, put it on container ships, flood the U.S. with goods so that goods inflation can collapse. That's not going to be what I think it's going to wind up being. It's probably going to be more services related, and it's going to be a difference there. So the biggest problem people have to come to grips with is this is a fundamentally different economy. The result of that is the economy's out of balance. And that leads to persistently high inflation and a friction in the economy. This is why the inflation rate is up. You can yell and scream it's about supply chains or it's about the war in Ukraine, and that it has factors in it. But once you've got rid of all that, you're still stuck with a high inflation rate and you're still stuck with very high interest rates. They're not going to come down till we recognize this is a different economy. We have to reshift, restructure this economy. That's a lot of spending. That's many years to do it. But instead of doing that, we'd rather engage in a debate whether or not it actually has changed. And most boomer managers that run, big firms, Dave Solomon's the chairman of Goldman Sachs is my favorite whipping boy on this, is adamant not a damn thing has changed from 2019. And that if we just sit here and hold our breath long enough, everything will go back to the way it was in 2019 or 2018. And it's not. And this is preventing us from having that soul-searching question is, what is this new economy, this post-pandemic economy look like?
I'm loving this conversation. And I was actually thinking about this a lot, these past few days. And if we could just, look at it from a sociological standpoint about, our new normal, if you want to call it. And I had Kevin O'Leary on recently who was saying, he can't he can't hire and have people in the office. No one wants to come into the office anymore. It's like, this is a collaborative effort where we're all like saying we're not going to come into the office. But when does that change? When does that shift change, Jim? That someone's like, you know what? I'm going to take that job because I need it. I need it now to feed my family and provide for my family. And if it involves going in the office, I'm going to go in the office. And then that butterfly effect starts. Don't you think at one point it gets so bad that if you want a job, you're going to have to go in?
No, I think it's the opposite. And let me explain. I think, first of all, if we can agree, that there has been that change. As O'Leary said, people don't want to come into the office. If it was 2018 or 2019 and you had a friend that didn't have issues, let's leave that on the table too, and said, you know what, I got this decent job with this guy on Shark Tank, but he wants me to come into the office every day. I don't want to take the job. You would have said, what the hell is wrong with you? But in 2023, that is the sociological change that we've had. You want to get people into the office? I'll pay you 10% more to come in the office. I'll pay you 15% more to come in the office. Pay more money if you want to get them to come in the office. So how do you get people back to the office? A boom. You get them back in a boom, and I'll just give you more money to come into the office. Not as a stick that you need to feed your family to get back. Remember, we have 3.4% unemployment, so that's not the issue. The second thing you want to get people back into the office is, I'll use Manhattan because everybody's familiar with it. And I'll use my word again, dystopian. If you want to talk about what dystopian is, I've taken the New Jersey Transit through the Port Authority. That is dystopian. Fix that. Fix that now. Make that less of a terrible experience. I'll give you one slow standard that you could start. I don't want to smell urine when I walk through the Port Authority. That's why people don't want to go into the office. The cities need to be fixed. They need to be reoriented. You need to make it not a terrible experience getting to the office.
You mean not risking your life taking the subway?
Right, exactly. Goldman Sachs in September.
Who knows if I'll die today?
Right. And it's happened. Goldman Sachs in September, right after Labor Day, said, we want everybody back in the office 5 days a week. A week later, one of their employees was shot and killed in Brooklyn on the subway. It's already happened. It's already happened. This is what needs to be. Oh, by the way, you have to fix it, and that's billions of dollars, and you can't raise anybody's taxes. That's why the cities have to start rethinking this. This is going to get people in the office. This is why they don't want to go to the office. And it's a waste of time in the politics associated with the office as well, too.
And I know there's other topics I want to cover with you, but I guess as a final point, just because I guess many of my friends were affected by the recent tech layoffs, Microsoft, Amazon employees, and I'm just wondering, well, if part of it was, if you have another job, but it involves being in the office, I just wonder if then they would bite. Specifically at the tech sector, that's just been totally destroyed.
There's two things about the tech sector right now. There's been a lot of layoffs in the tech sector. Actually, three things. And I think the first thing we have to keep in mind is if you look at total tech employment from 2019 to now, they hired like crazy during the shutdown. The Zooms of the world, the Metas of the world, the Googles of the world, and now they're cutting back on people, but they still have more employees. Even Meta, after the latest bloodletting that they announced yesterday, and boy, did they botch that too, that they said something along the lines that Zuckerberg's going on vacation and they need to lay off everybody before he goes on vacation. Boy, that's just not a very good look when you make that kind of announcement. But nevertheless, they're still going to have more employees than they had in 2019. So they overhired and they're pulling some back. That's the first thing. The second thing I would argue is the impact of what's happening at Twitter. Now, I know Twitter is kind of a lightning rod type of statement, but let me make a somewhere around half to 2/3 of the employees of Twitter have been laid off. And most people would argue Twitter's not that much different than it was when they had all those employees. Oh yeah, it has its issues. It goes, it has this flakiness with the tech and stuff like that, but it did before that too. And I think a lot of tech CEOs and tech executives are looking around going, could we get rid of 2/3 of our staff too and still maintain the same quality of our product? Do we have all this extra dead weight? And the third thing that's leading to that is there is a push among investors by pounding the tech stocks as bad as they have in the last year, that they're turning to the Amazons and the Metas. And they're saying, you know what I need you guys to do? I need you to make money now. I need you to make money right now. I don't need you to tell me a story about why the metaverse is going to be this wonderful thing, and in 5 years you're going to make a lot of money.
Right.
That's fine. I need you to make money now, and the best way you can make money now is get rid of 1/3 of your staff. And so this is what the tech sector is definitely going through. But what I tried to explain there is it's not emblematic of what's happening in the rest of the economy. It's kind of unique to tech.
Yeah.
Tech was always unique anyway as well.
Shifting gears, I want to talk the dollar, and at the crux of your thesis, you say no landing and higher rates equals higher dollar. Talk to me about the trajectory you see for the US dollar here, Jim.
So a couple of things, right? So what are the two biggest things that you could push for the idea that the dollar would be strong? Well, relative interest rates is still a big picture, not a day-to-day trading type of thing, but a big picture benefit for the dollar. Our relative interest rates, we're at 5, Europe's at 3, and we're going higher. And Europe's going to go higher too, but relatively speaking, put your money in the US dollar and you'll get a higher interest rate. So that's going to keep a bid to the dollar, and it's been going up. Second of all, in an uncertain world, what we learned in 2020, again, and this is mainly for non-dollar investors, not for American investors, but what does the rest of the world do when things get dicey? First, put all your money in the US dollar. Second, figure out what's going on. So it will always benefit from uncertainty, the US dollar. No one ever says, boy, things are getting messy and there's a war in the Ukraine. I ought to pile all my money into the Japanese yen or the euro. No, it doesn't work that way. It's the opposite. You go into the reserve currency first. So that will benefit the dollar, any kind of uncertain world. And I'm talking about what trade frictions with China, the Ukraine war, uncertainty about the economy because it's a post-pandemic economy. All of these things will help to really push people into the dollar as well. So I think ultimately what we're looking at is a bid for the dollar, and I'm talking about like for the balance of the year, not just very short term, kind of like we saw last year. So we had a correction in the dollar, and I think that correction has pretty much run its course, and we're going to see the dollar continue to move higher. Now, what would change that? Would be a global recovery, where people would turn and say, I'd rather take risk in emerging markets, or I'd rather take risk in European banks, or I'd rather take risk in something other than the safest instrument, which would be the reserve currency. But that's not the way people are viewing the world. We're talking about recession, we're talking about war, we're talking about frictions with China. So that will continue to push people into the dollar.
So, okay, a few points here. What do you say, for the counter argument of, well, look at the rise of the BRICS, look at the countries dumping dollars, they're looking at the sanctions that were placed on Russia. They want a way out of the US dollar. I'm talking reserve currency now. What's your, counter argument to that of why the dollar will continue to reign supreme?
So you're right that the nanosecond you could come up with an alternative reserve currency to the US dollar, everybody will abandon the US dollar. But that doesn't exist. It's not the euro. It's not the won or the yuan or whatever we're calling it this week. It's not going to be the yen. It's not going to be the British pound. It's not going to be any fiat. It might be a cryptocurrency in the future, but that's many years down the line. They're not ready yet to assume, any of them, even Bitcoin, to assume the role of a global reserve currency that can trade trillions of dollars a day and be a settlement for global trade. Only the US dollar has that capability right now. Okay. So they're stuck with it by default. And I get what you're saying about the BRICS. And I get that, the Saudis are talking to the Chinese about the idea of maybe, settling in yuan or settling in something else for petrol or for crude oil purchases. But the Saudis like being very rich. And if they decide to go with a different currency, they're going to be a lot less rich. And I think at the end of the day, I think they're going to come to the conclusion of why we hate the dollar and we don't want to use it. We have no choice because there's no other alternative for it. Now, that's not for the U.S. to sit back and say, see, we win because somewhere someone's going to create an alternative. And unless we continue to refine the dollar as a reserve currency, refine our laws, refine our economics to continue to make it the most desirable option for reserve currency, somewhere somebody's going to come up with a better option. But right now, that option doesn't exist.
Right. Someone's going to come up with a better option. And, there's so many theories circulating and we don't know the truths, but, I'm sure you've seen one of this is the reason that China's secretly been buying or hoarding gold. Could they be planning some sort of, central bank digital currency backed by gold? I mean, who knows?
They could, but it's not gonna, there's $1 trillion a day plus of foreign exchange and trade settlement, $1 trillion a day of trade settlement every day. Gold can't do that. A gold-backed CBDC could take maybe 1/3 of 1% of that. It cannot replace the dollar's role in all of that. Now, that's not to say it can't in the future, but for the immediate future, no, it can't do it.
What are your thoughts on central bank digital currencies in general? Are they coming faster than we think? Not as fast? Never?
I think they're coming faster than we think. I think that they want to do it, and I think that they are probably the worst idea that we've got going in finance, because what they are is they are not an evolution in finance. They are just a surveillance state tool. They are going to be used to manipulate behavior and to surveil on people to a degree and a level that I think most people in the free West will find very uncomfortable. And I think that this is a dangerous precedent to have central bank digital currencies come down the line. But unfortunately, I don't think a lot of people are recognizing where they are. The thing about them is, if you look at the one country that has really pushed hardest on this has been the digital yuan in China. That's right. That even in China, they've had a hard time getting acceptance and adoption for their central bank digital currency. And because people don't like that, what the central bank can do, what the government can do is they could say, here's your dollars, and we're going to put restrictions on what you can do with those dollars. You can only spend them here. You can only spend them in this areas. You have to submit a cholesterol test. I'm using an extreme example to get my point across. If you want to buy a steak dinner, we have to know what your body mass is if you want to buy sugary drinks. This is the type of stuff that a central bank digital currency makes the government capable of doing. We don't want you to buy certain things. Maybe it's guns, or maybe it's adult entertainment, because we've decided that they're verboten. This central bank digital currency allows, with the stroke of a couple of keystrokes, to prevent you from doing any of this stuff or all of this stuff. And this is why I think that people are more and more understanding that this is not an evolution in finance, but this is a new tool for the surveillance state, and why it's going to try to get adopted, and it's going to be very difficult, I think, in a lot of Western places to see a central bank digital currency get adopted.
Jim, I want to talk the crypto sector now. Fed Powell, just said we don't want to strangle crypto innovation, but the sector is a hot mess. I mean, yeah, obviously. But your take on regulation coming for crypto and what it could mean for the sector?
He wants to strangle the regulation or crypto. They view crypto as a mortal threat to themselves and a mortal threat to the state being able to issue currencies. There's a pincher move going on right now in regulation. On the one side, you've got the SEC and Gary Gensler running at the SEC, and I'll stick with the U.S., pushing down a lot of regulations. The big one is about the custodial services that that the exchanges, the Coinbases and the Krakens and the Geminis try to do, and saying you as a regulated advisor or as any kind of regulated entity, you can't use those kind of services to hold your coins. You need to use something like a bank to use them. And the SEC goes, we're fine with you using a bank. But then on the other side, you've got the Fed saying to all the banks, they're using this new tagline, safety and soundness. You don't want to be anywhere near the crypto space. It's dangerous. It's full of fraud and it's full of failures. And to some extent, that's true. I mean, it is true. But this is also what happens with new technologies as well. I can imagine a Jay Powell in 1999 saying, see, Pets.com failed. That whole e-commerce thing is going to wound up being a bunch of nothing because it's a bunch of fraud and failure is all e-commerce was, which is what it was in the late 90s. And how's that look today, 20 years later? But this is the way all new technologies do come about, is they come about in a very messy, chaotic way. So you've got that pincher move, push everything to the banks, and then the Fed is telling the banks, don't touch it. And they're trying to not allow the technology to foster and percolate on its own. And it's going to be a very difficult period, I think, for crypto and for the whole blockchain, decentralized blockchain experience moving forward. I ultimately think it's going to win. I ultimately think it's going to prove to be a better technology. I'll ultimately argue that it's going to be somewhat like, ride hailing and ride sharing, where every city in the world tried to ban it and block it, and the taxi drivers turned their cars over and set them on fire. But at the end of the day, the public wanted it, and the public got what they wanted. And I think that as time goes on and as crypto evolves and cleans it up its house, I think the public's going to find it more and more attractive, and that it's going to be harder and harder for them to do anything about banning it.
So where do you feel the greatest opportunity lies, in the crypto sector? As an investor, where would you be?
I think that at this point, I'm assuming that this is not the number go up question. When is Bitcoin going to go to 100,000 or something like that? No. I don't know. But I'll answer the question this way. I just recently read a book by Edward Chancellor called The Price of Time, and it's about the history of money and banking to the beginning of civilization many, many thousands of years ago. And what was interesting about the book was he said that we being the beginnings of civilization, we actually invented lending and debt and banking first. That was invented first. And that's why to this day, we still use agricultural terms like yield to explain basic terms within debt and banking. Then we decided that when we were doing that banking, it was all about bartering with, calves and cows and bushels of wheat. We needed to make it more efficient. So we invented money second. And I know people think it came the other way, but in the crypto space, it did. We invented money, Bitcoin first. And then we decided, what are we going to do with this money? And unfortunately, we created a casino. And that's why it's got this reputation of being volatile and being speculative and scammy. But I ultimately think what we need to be thinking about in the crypto space is its future is decentralized finance. Now, whether that's on the Bitcoin blockchain because of the Taproot upgrade, or ordinals now with NFTs over there, or whether it's still on the Ethereum blockchain or some other level 1 blockchain that you could create decentralized finance, remains to be seen. But we need a way to say, we've got this money, but here's a way you can bank it. You can lend it, you can borrow it, you can trade it, you can get a yield on it, you can insure against it, all in a decentralized way. Now, you could argue, we've got that now. Yes, only for a bunch of computer nerds because it's way too hard for the regular public to use. It still needs much better improvement in the UI and UX in order for the public to start to see adoption on a serious level. But ultimately, so what I'm leading up to is I still think decentralized finance, and I'm going to put NFTs into that decentralized finance bucket. Use cases for this stuff is where we're going to go. And that's going to be what's going to drive the adoption. What's not going to drive the adoption from here is number go up. Oh, if only Bitcoin go to 100,000, everybody will degen into Bitcoin again. We did that in 2018. We did that in 2021. And everybody that will degen into it because it's running to 100,000 knows it'll go back to 10 or 15 again, and they're going to run out of it on another day. But if you put together a solid, understandable use case for this stuff, then it becomes unstoppable. And I know that the industry understands that, agrees with that, and is finally starting to work towards that, both on the blockchain, on the Bitcoin blockchain, on the Ethereum blockchain, and a bunch of other ones as well, too.
Jim, I guess just to wrap here, we painted the picture that it's clear the world economy is clearly out of balance here. So sectors you like right now, I mean, are there any safe havens out there or opportunities?
On the safe haven aspect of it, yes. There's an obvious one, and it's something we haven't had to think about for 25 years. It's cash. Now, most advisors will tell you, put your money in stocks because over the long term, the stock market has historically returned you around a 9% return. Okay, that's right. I could get 5 right now in a 6-month treasury bill, and I take absolutely no risk. I could get 2/3 of the stock market's return for no risk. So that is going to be a powerful incentive for people to say, maybe the bulk of my money should be right there because, it's a decent return and I don't care what mushroom cloud occurs tomorrow. My investment is safe. And so that's where I think, when you talk about a safe haven, that's the biggest change. And over time, that is going to continue to be a problem for riskier markets, because if you look at like assets and money market funds and stuff, it's starting to go vertical because people are starting to realize I can get 5% for no risk, sign me up. And all that money is starting to flow into that. Now, if you're looking to do something else and take more of a risk, I still don't think the bond market is quite ready to be there yet. I know, other than the high yield on the short end, I'm not so enamored of on whether or not I want to buy the long end of the bond market, like the 10 or 30 year, because you could get a big capital gain when prices rally. I'm not ready to go there yet. But let me come back to one other thing. When I was talking about the world economy needs to be restructured, that restructuring, I think, means 2 things. One, I think it means a wholesale rethink about investments. I think we're going to go back to the 90s. And what I mean by that is we're going to go back to stock picking. It's not going to be anything more about, should I buy energy? Should I buy tech? Should I buy cloud computing? And what ETF should I buy in energy, tech, or cloud computing? It's going to be which cloud computing companies you're going to buy, because some of them are going to go up and others are going to go to zero. It's going to be which tech should I buy? Which energy should I buy? So it's going to come down to the old Peter Lynch stock picking world, I think is where we're going to go. Now that I've said that, virtually everybody's unqualified to do that. Oh yeah, we're going back to stock. No, you haven't had to do it for 20 years. You've got no real skill in doing that. And it's going to be a painful process of relearning that old skill. Beyond that, I do think if you believe what I believe in the restructuring of the economy, I would lean more towards infrastructure, industrials, basic material, manufacturing, shipping. I think that all of those areas are going to, and it's not just what ETF do I buy? There is no shipping ETF. It's going to be having to, and most of all the shipping companies anyway are not even US to begin with. It's going to be to try and understand this new restructuring of the economy and going stock by stock. So unfortunately, what I told people is, one, is something they haven't had to do in 20 years. And 2, I've told them it's extraordinarily difficult because you got to go stock by stock, idea by idea. It's not just, here's 3 ETF tickers, go buy those, and they're going to go up. That worked tremendously, buy these ETF tickers from 2000 to 2020. But that era, I think, is over, and we're into a new post-pandemic era. And with that is going to be more micro-based investing and less macro-based investing as we move forward.
So even if there's still trillions being pumped into the system, it's not going to keep everything afloat.
Right, because where that trillions is going to go is it's still going to go. People are still going to think, oh, I got to put my money into office real estate because it's down a lot. I mean, that mean reversion type of mentality. Or I got to buy Signature Bank because it's down 98%. Where can it go? Down 100% is where it can go. And you can lose all your money even at this point. So yes, that money, even though that money gets pumped into the system, and yes, over the short term, what the Fed says and the macro stuff will pump and dump on the broad averages.
Right.
If the question is what long-term ideas are going to be out there, it's going to be more of a micro type of world, I think, because it's more of a different type of world. It's more of a world in change. And since we're in a world in change, you have to pick those companies that are on the leading edge of that change. It's not unlike it was in 2000. In 2000, as I said, you might have said in 2000, I think e-commerce is going to be the thing. And you were right. It was the thing. And then you would have said in about circa 1998, so therefore, put your money in Webvan, put your money in pets.com, put your money in Peapod, and they all went to zero. And then you would have said, this e-commerce thing is not going to work. And then Amazon went to $2 trillion in market cap. So this is going to be kind of the same type of thing as it was in 20 odd years ago. I think it's going to be stock by stock. And I know that a bunch of people stroke their chin and go, yes, you're right. Yeah, but you haven't had to do that in 20 years. And it's a very, very difficult thing to do.
Now it involves a lot of homework.
It involves a lot of homework. a lot of homework that people are not used to doing. They're used to picking sectors. Exactly.
Let's wrap with this, Jim. I always leave a little place here to talk gold because I have no idea what's your take on that when it comes to a place in a portfolio, or maybe there's no place for it. How do you see gold?
Long-time gold bug, very, very gold frustrated is the way I would describe myself. And the reason I would describe, let me put it this way. What is the purpose of gold? What is gold supposed to be, the way that Peter Schiff describes? I love Peter, by the way, even though I'm kind of needling him a little bit. And that is, it is supposed to be a way to say, I'm uncertain about the financial system. Maybe it's inflation, maybe it's deflation, maybe it's financial crisis. How do I get my money out of the financial system? Well, it's not a really easy way to do it, but the closest way we've got to do it is gold. Now, the problem with gold over the last 20 years, 30 years, is we financialized the hell out of it. We've got GLD. We've got other ETFs on gold. We've got options. We've got derivatives. I can't tell you how many people have come up to me over the years and said, yeah, I'm very, very uncertain about things, so I'm going to put my money in gold so I could rest easy at night. Well, how'd you buy it? Well, I bought GLD. Well, I got news for you. If you really think that the financial system is on the precipice of something, GLD is going to do you no good. The New York Stock Exchange is not going to burn to the ground and GLD is going to go up because you're worried about the financial system. You have to buy coins and bury them in your backyard. Oh, I don't want to do that. I don't know how to do that. Okay, buy warehouse receipts in a foreign country. I have no idea how to do that. So because we financialized gold, we've turned it into another fiat currency. So it trades like the yen, like the euro, it trades like the yuan. So when the dollar goes up, gold struggles, and when the dollar goes down, gold rallies. So it's no different than buying the euro. If you want to get gold back to its original casings, if you will, we got to get rid of all this financialization and say it is somewhat disconnected to the financial system. But just like with stock picking, that's hard to do. How do I buy a warehouse receipt in a foreign country saying that I have some gold bars in that vault that are mine? That is very, very difficult. How do I buy a bag of coins and bury them in my backyard? I'm not a prepper, but that is how you want to get to thinking about gold if it is going to be what it historically has been. But if your answer is, no, I'm going to buy options on GLD because I think that, things are going to get dicey in the Ukraine, and your options on GLD aren't going to be any good if things get dicey in the Ukraine. That's inconsistent with that idea.
Yeah, I don't think it's so hard to do. I don't agree with that point, but I hear what you're saying.
For a lot of people, it's too hard to buy futures, they incessantly want an ETF on everything so that they can go, on their Schwab account and buy it in 13 seconds. And if they have to spend more than 14 seconds on it, it's instantly become too hard.
Oh, right. Point made. Jim, I could keep going on and on with you, but so just come back another time because I really enjoyed this conversation. Thank you so much.
Happy to anytime. I enjoyed it too. Thank you.
Awesome. Jim Bianco, first time on the show. I loved it. I hope you did as well. Be sure to stay tuned to the Daniela Cambone show and sign up at danielacambone.com so you can stay on top of all these awesome interviews. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.